Dollar cost averaging is, in one sense, not a particularly productive idea. And that is to say, if you've got, say you come into $1 million from your nice deceased aunt and decide you will average into the dollars, you'll probably do better most of the time. Nothing is universal if you invest it all in the same day.
Right.
That's the plus, because the longer you hold a stock, the better it tends to do. The big minus is that you might have picked basically the day that I was born to start investing in May of 1929, and in which case the $1 million goes to 100,000 by 1933. Stock prices go way up. You're happy. You think, boy, have I been smart here? But you should be sad if stock prices go way down in your, let's say, 6th year of investing. Well, all of a sudden, you're getting more shares for each dollar you invest. So it's a way of eliminating, to the maximum extent possible, the vagaries of the stock market, which in the short term do things for no explainable reason.
Welcome back, ladies and gentlemen, to the late, great Jack Bogle, discussing what is better, doing lump sum investing or cost averaging investing. And on this video, I'm going to try and share with you the best knowledge possible as a dividend investor that primarily sticks to the idea of dollar cost averaging. As your paycheck comes in, you find places to put it. But there are definite certain circumstances where this is a terrible idea. And I look so forward to kind of getting into the ins and outs and being your Sherpa, your guide on this financial independence retire early journey. So ladies, gentlemen, let's get right into this.
Drop it.
So kind of deep diving into this knowledge, I've come across some great quotes that are timeless in stock market investing, like the market can remain irrational longer than you can remain solvent, which is why we don't want to make investment decisions based off listening to like stock market crashes coming, the gold bugs out there. We kind of want to make good, solid decisions based on value, which I'm going to show you a video that sums this up in a really good way. But I want to show you some stocks in the first place that I would consider terrible to do dollar cost averaging in, and that's pretty much all your top tier S&P 500 stocks. To show you a few as an example here, do you think it's better to dollar cost average into something like Microsoft? Probably not. We got Apple here. We got Google. We got Johnson & Johnson even Amazon, Visa, all of these companies. If you were buying them over time, you're always steadily paying more than you probably paid for them in the past, unless you're like Jack Bogle here, who started investing, during the just before the Great Depression or anything like that. But at the same time, guys, I'm going to show you some stocks where you'd be much better cost averaging into and where I take personal advantage. But I want you to listen to some tidbits that I found off basically Phil Towns. I'm sure you've heard of Rule 1 investing, but he's got some really good knowledge. So I'm going to turn the volume up here and I want you to take a quick listen.
Your stock price with it. So you're not hearing me wrong. We want it to go down, not up. See, if it goes up, we do okay, right? If it goes down, we get rich. And this is hard for most people to grasp. I know it sounds completely nuts, but remember, our net worth is not about prices, at least not in the short term, right? It's about value. If prices go down, but we know what we're doing, our net worth is going to go up big time. We're not expecting to cash out today or tomorrow. We are consumers of stocks for many years into the future as investors. Therefore, we want the price of the thing that we're consuming, any business or stock that we want to stockpile, we want that to stay low so we can buy more of that great company at ever better prices.
So I think Phil Towns really touches base on some really important information here, because kind of we always want capital to deploy into the markets as, we continue to build our accounts over time, getting us closer to our financial independence, retire early journey. But there are two breeds of stocks. Now, if we head into a crash or a recession, obviously timing the market's impossible, but time in the market is better than timing it. So in my personal opinion, if you're buying top tier companies like I did when I bought Johnson & Johnson, I just loaded up up as quick as I could, because these are companies that don't offer discounts for very long, and Johnson & Johnson does really small blimps now and again that allows you to get into them. But what are positions that I would consider the best to cost average into? Well, I can give you a few examples of stocks that I was loading the boat on all of last year, and these are companies that are in downtrends. And a downtrending stock is really apparent if you know what you're doing within the market. If you watch my channel long enough, if you've been scooting around on YouTube listening, you'll probably see these come up once in a while, and soon you're going to start recognizing them on your own. But MO is a personal example of mine that I cost averaged into, and I will show you my current yield on cost with those. There's a recent one that's come up a lot. We got Carnival Cruise. I would consider to be a great company to cost average into, and we can see the time frame of a downtrending stock can be anywhere from 3 to 5 years, considering Carnival Cruise has been on a downtrend since 2018. MO's been on a downtrend since the mid-2017. Wells Fargo is one that I've been recently cost averaging into, and these are the kind of stocks that I like to look for when I'm just growing my portfolio over time. Because usually if you're getting into the markets, you try and save up a bigger chunk of cash, and I recommend kind of dispersing that amongst your core stocks. There's just core stocks you should have in your portfolio, and we're obviously talking about those S&P stocks, like your Visa stocks, right? Like, you're not going to get a huge dividend yield, but at the same time, it's just great to have them because you're going to see that capital growth continue to come in over time. Whereas if you're primarily a dividend investor like myself, you're going to be better off looking for these discounted stocks that are likely to return to some fair value over time, as we're trying to find them good, deep discounted value stocks. And Wells Fargo fits in that criteria for me, considering they've had a lot of bad news. They've been losing revenue, sure, but I think it's a short-term pain for long-term gain. And I like the fact that the stock has been down, trending for the last 5 years, really, really slowly paced, which is going to give me plenty of time to get in, as my time horizon looking out is 10, 20, maybe even 30 years from now, collecting those payments along the way to try and find better places to redisperse them. Now, here's one that I'm buying right now that I've been cost averaging into, and this one has become somewhat of a mistake at this point because it's starting to flip the other way and we're seeing it uptrend. And I'm going to show you my personal price that I'm paying for this and how I'm scaling it, because I was buying this, you know, pre-2019-ish, and I started getting into it. It's RioCan. It is a REIT, and over the last 5 years, it looks like it's been primarily on a downtrend, which I mentioned that you usually see these last for about 2 to 3 years, where you have really good opportunities to get into this stock unless you were buying at all-time highs. Then things get a little bit more scary. But again, big difference between your S&P 500. You should always focus on those core positions being your big lump sums, and these kind of smaller cap, higher yielding stocks to be your cost average stocks, because you're going to end up in a situation where if you don't catch the cost average and you're averaging up, and I'm telling you that I feel like I'm making a mistake the way I've been buying this stock, because if we go into my personal accounts here, looking at RioCan, guys, we can see that my average yield on cost right now is $26.46, and I have been steadily still averaging into this, but it just keeps going up. So my yield on cost, I continue to lose more and more of it as the stock goes up. So you can kind of see where this becomes a mistake if you're too late to catching a stock. Now, is this a bad investment? Well, we'll see how it turns out over the next 3 to 5 years, as you can't really gauge your personal investments in such a short time period. But I don't like getting caught in these traps where all of a sudden you think you're catching the end of it and you're not getting in fast enough just to see it keep coming back. So you're going to end up paying quite a hefty premium as you cost average in. So I'm lucky I managed to put a big deposit on this stock. When I find these discount values, I try and throw in a couple grand starting, and then I'll add about 500 to 1,000 a month. And I'll be continuing to do this over the next few months with the dividend income that I have until, as many of you know, I get my positions to full scale. But where cost averaging, in my opinion, worked really well is on a company like MO or BTI, my sin stocks, guys, because last year these things were getting beaten up, and we can see my yield on cost for MO is $46.22, which is pretty incredible stuff, guys. And on British American Tobacco, I've got an average yield on cost of $39. And that's because when these stocks were hitting major downtrends after a couple of years, I figured I would spend a whole year just hammering in getting those stocks built up. And sure enough, it worked out fairly well for me. And like Phil Town says, you want to be buying them as they're downtrending. Sure, you're going to see your capital go down, but if you understand the stock that you're buying, the value will well exceed that in the future when it comes back into fruition. And honestly, guys, I think it happens faster than most people think. Like I said, I've been buying MO and BTI for under a year. These stocks pay out massive yields, usually between 6 to 8%, depending on when you were buying them. And we can see with even British American Tobacco, I am already sitting up 12% after investing over a year, building these up to scale. Now, these positions might look kind of large. If you're new to investing and you're starting with smaller amounts, this is going to be ever more challenging because your upsides aren't going to be massive, and capturing these really decent value stocks, I don't think are going to give you as much value as, you know, lump sum investing and trying to save up that first 2, maybe 5 grand and dumping it into a stock like Facebook, like Apple, like Microsoft. Many of you know I've been recently buying Facebook, but in my opinion, if we open up Facebook here to give you guys an idea of what's going on with this stock, this would be an example of lump sum investing for my personal portfolio, because if we look at a 5-year chart on Facebook, it really doesn't offer a lot of dips. And I was lucky enough to be buying my mom Facebook when it was around 170, when it started coming back from its first dip. But this isn't a stock that offers a very like 3-year, 5-year time period of downtrend unless things get really bad on the market, which again, we are not trying to gamble and figure out when the market crash is coming. So when I liquidated some of my Tesla shares, many of you know I just loaded the boat. I literally did one quick buy on Facebook, and I'm starting to recognize now where I've seen myself in cost averaging and lump sum investing, which leads me to ask you guys, how have you been taking advantage of both these investment strategies? Are you new to investing? Is this something you're just learning about? I'd love to know what you think in that comment section below. A quick Sunday video for you guys, so stay cool, stay awesome. I look forward to chatting to you real soon.